Hi everyone, I'm Jamie Fleming, and I'm the Director of Communications and Research at Teamsters Local 174 in Seattle. I'm going to be presenting a brief background and analysis of UPS's financial position that I hope will be helpful to you. As far as my own background, I majored in Finance and International Business at Georgetown University, where I graduated summa cum laude and received the Credit Suisse Financial Award. Before working here at Local 174, I was a financial analyst for the IBT for nearly 10 years. My goal here is to help you understand where UPS makes its money and how things are trending so that you can understand why the National Negotiating Committee took the approach that they took. Since UPS is a publicly traded company, they report their financials at the end of every quarter. When they report earnings, they divide their company into three segments: International Package, Supply Chain and Freight, and U.S. Domestic Package, which includes ground, air, and deferred. For the purposes of this presentation, I'm going to focus exclusively on the U.S. domestic package side, since that is what this proposed agreement covers, and that is where our UPS members work. We'll start out with a simple chart showing their revenues. These are annual revenues for the U.S. domestic segment for the period from 2008 through 2017. As you can see, that revenues line has been trending up nicely, and that's good. We like to see revenues going up. Down here is the line showing their operating profit. Keep in mind that operating profit is 100% pre-tax. Operating profit is basically just the revenues minus the operating expenses. As for those operating expenses, those include all the costs they incurred in order to make those revenues. So all the costs associated with the Teamster contract are showing up there. Now, you may have noticed that the operating profit line is not trending upwards in the same way the revenues line is. If we pull that line down here to compare them, we can clearly see that the growth rate is not even close to being comparable. What's going on here? Well, let's look into it. The next chart we are going to look at shows profit margins. This blue line here shows UPS Domestic Package's annual profit margins every year from 2008 through the first half of 2018. The operating profit margin is simply the amount of operating profit as a percentage of the amount of revenue. So when we look at this blue line, what do you notice happening from 2012 onward? The margins have been decreasing. Now, obviously, UPS is not on the brink of insolvency, and they're still making a healthy amount of money from the domestic package business. But let me be clear, you do not want that arrow pointing down. In a healthy business, you always want to see growth, growth, growth. Revenues growing, profits growing, margins growing. This is concerning, especially because we're currently in a period of economic growth. It's about to get a little scarier over here now. The blue is that same line we were just looking at, but now let me add another one. Can anyone guess what this purple line might be? I'll give you a hint. It's purple. The purple line is FedEx Ground's operating margins, and as you can see, they are consistently higher than at UPS. But that's no big surprise. I mean, why do you think FedEx Ground's operating margin would be so much higher? Because they don't pay their people nearly as much. Just to really lay out this profit margin situation for you, this is an average operating profit margin for UPS over the last 10 years. It's 11.79%. And here's FedEx Ground over the same period, 15.04%. Okay, so margins kind of give you an idea of what's going on, but let's get deeper into this by looking instead at some actual hard numbers. This blue line shows quarterly profits at UPS Domestic. Now, this line bounces all over the place because, as you well know, UPS's business is cyclical. It peaks at, peak, and then the troughs are the slower summer season. Now, here's the line for FedEx Ground. So even though the margins are higher as a percentage of revenues, the actual dollar amounts for profits are still below UPS. But since these lines are bopping all over the place, I've asked Excel to draw us a trend line. So here's UPS's trend line, kind of holding steady and arcing slightly downwards as they run their marathon. And here's the FedEx Ground trend line, arcing upwards, nipping at UPS's heels. But wait, there's more! Are ground packages the only thing in your trucks? No, you've also got air. And at FedEx, ground and air are not delivered on the same trucks by the same people. Air packages are delivered by FedEx Express. So look what happens when I add the profits from FedEx Express on top of the ground profits. It's higher than UPS. On a hard dollar basis, FedEx Express and ground together are more profitable than UPS. And this is just one competitor. There's also OnTrack, Uber, Lyft, Amazon, and others. UPS does not exist in a competitive vacuum. Imagine what that line would look like if I stacked all the non-union competition's profits up on top of it. Think about what that means for you. The competition pays significantly less than UPS in wages, healthcare, and retirement. On healthcare and retirement, it's almost ridiculous to even compare them at all. They're that far behind. But when it comes to eating up market share, they are catching up quickly. Now, I assume there are some amateur Wall Street traders in the audience, so let's take a second to look at stock prices too, since I know that's something that is often on people's minds. This is UPS's share price performance over the past 5 years. I pulled these numbers on July 31st, so they are exactly tracking the dates of your last contract. UPS stock price went up 36.76% over that period. However, stock price performance is absolutely meaningless without context because a rising tide lifts all boats, so when the market is going up, everything is going up. Or at least everything should be going up. If your stock is going down in a bull market, you better jump off because your ship is sinking. No, what we need to do is compare how much UPS increased to how much the market and the competition increased. Here is UPS versus the S&P 500, which is an index fund that tracks the performance of the entire stock market. The S&P 500 grew 66.25% over that same 5-year period, so UPS underperformed the rest of the market pretty significantly. By this point in the presentation, you should pretty much know what's going to happen on the next chart. FedEx stock, 126.83% growth over 5 years. UPS likes to act like their pockets are bottomless and the sky's the limit, but they're not, and it's not. They are losing ground in a major way. There's one last piece I really want to bring home for you guys about the offer you have sitting in front of you. This bar here shows the cumulative operating profit that UPS Domestic made over the last 5 years of your contract. So this goes from mid-2013 through mid-2018. They made operating profits of $23.331 billion. Now that sounds like a lot of money, doesn't it? Sounds like someone can totally afford more than $4.15 in raises, right? Well, let's put something in perspective. This proposed contract is projected to cost UPS close to $15 billion over 5 years. That is over $4 billion more than the previous agreement, which is an increase of 36%. If this contract had been in effect for the past 5 years, UPS Domestic Package would have made 17% less operating profit. Now, I'm sure some of you are thinking, good, take it, they don't deserve it. And I'm not saying I disagree with you, but remember this chart with that operating margin arrow pointing south? Think about what that means in 5 years, in 10 years. And of course, I can already hear many of you wondering this. You saw that bar chart and saw how much was still green, and you wanted to know why the negotiating committee didn't get you part of that bar too. What does UPS need all that money for? I'm about to tell you something important, and some of you aren't going to like it, but it's something you need to understand before you make your decision. Without sufficient profits, UPS has no incentive to invest in growth. Adding capacity, adding buildings, adding routes, adding Teamster jobs. And if UPS stops investing in growth, what would that mean for the Teamsters of the future? What would that mean for your ability to work for UPS until you can retire? What would it mean for the strength of our healthcare and pension trusts? When you stop growing, you start dying, and nowhere is that more true than in business. Thank you for listening.